Good evening. So welcome back to our second session of the day. And today we are learning a new concept that is money and banking. And I want us to start by definition of terms. So I want us to define the term money. And money refers to a medium of exchange in the form of coins and banknotes. So when we talk about coins, it's like 1 shilling, 2 shillings, and banknotes, you can talk of 100 or 1,000. And then we have banking is the business of accepting and safeguarding money owned by others and then lending it out to earn a profit. Then as we proceed, we have the characteristics of money. And one of the characteristics is that money is tangible, meaning that you can touch it. You can touch and feel it. And then we have divisibility, meaning it is essential that any asset which is used as money is divisible into small units so that it can be used in exchange for items of low value. So like for example, if you have 1,000, you can divide the 1,000 and you can get 100, 250 shillings. Then the other characteristics is acceptability. So by that we mean if money is to be used as a medium of exchange for goods and services, then it must be generally acceptable as having value in exchange. And then the other characteristics is which is not indicated there, but we have portability. It means that you can carry it around. And then we have scarcity. That means if money is to be used in exchange for scarce goods and services, then it is important that money is in scarce supply. That is, for an item to be acceptable as money, it must be scarce. And then we have durability. By that we mean that it should be able to last for a longer period of time. And then the next part that we are going to look at is functions of money. And since I believe everybody can see my screen, I would want someone to read for us the functions of money.
It serves as a medium of exchange. Then it is used as a store of value. It is a standard for measuring value. It serves as a standard of deferred payments. It transfers value.
Okay, so we have the first one that talks about, thank you so much, Winnie, for that good reading. The first one is a medium of exchange. And when we talk about medium of exchange, that means that it facilitates the exchange of goods and services in the economy. And then we have money as a store of value, or store of value and wealth. So the use of money, it makes it possible to separate the act of sales from the act of purchase. So, and money is the most convenient way of keeping any form of property, which is surplus to immediate use. And then we have money as a standard of deferred payment. By this, we mean that money transactions that involves the future payments, e.g., we can look at a hire purchase, mortgages, long-term construction workers, and bank credit facilities. Then we can also look at under money also we have something like known as a barter trade, and I want us to look at disadvantages of barter trade. And the first one, it is impossible to barter unless A has what B wants and A wants what B has. So by this, we are trying to say that if person A has a cow and person B has a donkey, then person A wants the donkey, then it will be possible for them to trade. But if person A has the donkey and person B wants a goat, then it becomes difficult to carry out the trade. And then the second disadvantages of barter trade is wastage of time, which it takes a lot of time when you are negotiating with the other person. And then the other disadvantage, it is possible to confuse the use value and exchange value of good and its value. So that one is self-explanatory. And then we have difficult to store perishable goods. So remember that you are doing barter trade, and it will be very difficult if something is perishable, then it will end up getting bad before you can even consume it. And then we have the other part, since we are talking about money and banking, then we can also look at types of banks. We have central bank and we have commercial bank. Then we have functions of the commercial bank, and the first one is they provide safe deposit for money and other valuable. So this is where you take your money to the bank for safety. And then the second one, they lend money to borrowers. So the is whereby when you're going to the bank, sometimes you can seek for loans, which you will later on pay with interest. And then we have they provide safe and non-inflationary mean for debt settlements through the use of checks. In that, no cash is actually handled. And then the commercial bank, they also act as the Central Bank of Kenya. And the last one is they offer management advisory services. So sometimes they will offer services to the advisory services to the management. And then we have the roles of central bank. So someone who can see my screen, please read for us the roles of central banks. Someone to read the roles of central bank.
It's government banker. It's also bankers bank. They also issue notes and coins. They lend. They managing the national debts. They also operate monetary policy.
Thank you. So we start with the first one, which is government banker. So when a government needs to hold their funds in an account into which they can make deposits and against which they can draw the checks, such accounts are usually held by the central bank. And then when we talk about bankers bank, the commercial banks need a place to deposit their funds. So in short, when they want to deposit their funds, they deposit them to the central bank instead of amongst themselves. And then we have issue of notes and coins. So in most countries, the central bank has the sole power to issue and control notes and the coins. And then the fourth point is lender of the last resort. And when you talk about lender of the last resort, we are talking about commercial bank often have sudden needs for cash, and one way of getting it is to borrow from the central bank. So the central bank, they'll have to borrow money from, not the central bank, sorry, the commercial banks. They usually borrow money from the central bank. And then we have managing national debt. So it is the responsibility for the sale of government securities or treasury bills, the payment of interest on them, and they are redeeming when they mature. So that is the sole responsibility of the central bank. And then we have operating monetary policy. So this is the regulation of the economy through the control of quantity of money available and through the price of money. Then we can look at the last part, and our last part is an assignment. So this is an assignment that I would want you to do. And number one, I will want you to explain 3 reasons that led to the emergency of non-banking financial institutions in Kenya. And then the second assignment is you state 6 functions of the money market in developing economy. Then number 3, I would want you to describe the history of the development of money. So that marks the end of our lesson today. Not unless you have a question, then the floor is yours. So if we don't have a question, have a nice day and thank you for joining.